Hey guys, how's it going? This is GM Trader again for another video. Sorry for the long delay between the videos, but I've been really busy in real life, and but I really wanted to have this video done for you. It's going to be a simple video, but an important one. I would like to explain a very important concept to allow you to understand why the market move and how they do it, and really the underlying reasons why the market goes up or down. Okay, so before we start, I would like to ask you to like and subscribe. That would help me a lot, and also help the channel. I do it for to help you guys, and it would be nice to show some appreciation. I will also leave my wallet address for anybody who wants to leave me tips, so that would be nice. And finally, don't forget to join the free group on the open chat. I will leave the link as well in the description. Okay, well, let's start. I want to talk today about liquidity. Okay, like the title says, liquidity is a concept in trading that is very important. Right. The first thing I want to say that the market, basically, you need to understand that the market is a place where the money moves from the end of those who don't know, okay, to the ends of those who know. Those who know happen to have a lot more money, or end up having a lot more money than those who don't know. Okay, so the market always finds a way to let the people who know in, because they have more money, and that's what makes the market move. So let's first get a definition. What is a liquid market? What's a liquid market? I don't know if you guys have been reading the little PDF that I released in the group and stuff like this, but I'm gonna repeat it. Liquidity refers to how quickly and easily you can buy and sell an asset, okay? But you don't want to affect its price too much. So if a market is liquid, when you buy an asset, you don't affect its price. Say for example, you want to buy $1,000 worth of Bitcoin, and Bitcoin is trading at 94,000. When you buy $1,000 worth of Bitcoin, you're not going to move the price to 200,000. On the contrary, if you buy $1,000 worth of like the last meme coin, you might move the price like by 50%, okay, because there's nobody trading. So what's the measure of a liquid market really is the ease of converting the asset to cash, okay? An asset can be more liquid at certain price, but also at certain time. So during the New York trading hours, for example, you can have a lot more exchanges, a lot more volume. You can exchange a lot more. We're still talking about Bitcoin, but we could be talking about Nasdaq, the dollar index, or the S&P 500. There are moments in time when the asset is more liquid. There's a lot more exchanges, and there are moments also in price where the asset is more liquid. It's important to keep that in mind. Say for example, you wanna you go to Nike, right, and you want to buy shoes like a lot of people do, and all those shoes are trading at $200, right? They are selling at $200, and they sell some of them, and but they are so expensive that they don't move a lot. They might sell maybe 50 pairs a day, or let's say in the best shop. Say those items, which I remember right now, the shoes, go down to $20. From $200, Nike decides, let's make a big promo and put them at $20. What's going to happen? At this price, you're going to have a lot more volume, right? You're going to have a lot more exchanges. People will buy. People, if you also be more buying and selling, Nike will be selling and you'll be buying it, because at $20, it's a steal, right? So that's what you think. even if Nike had them done for $5, in wherever, in India or whatever. But still, in your head, this is a good price, so you're gonna buy it, and that's gonna create more liquidity. More people are gonna buy and sell and buy and sell, and it's exactly the same thing for Bitcoin, for Nasdaq, for whatever, like barrel of oil or whatever. Okay, so that's an important concept. What I'm talking about this is you now need to think about the market as if you are trading 50 million, right, dollars. If you guys really want to understand how the market moves and why it moves the way it does, you need to think like a smart trader, like a rich trader. And you will understand, that will be your homework. You'll have to watch more and more the market and see for yourself. I'm going to have a few examples because I don't want to be too long. I want to make this explanation as easy as possible, but and then we can expand a little bit in maybe other videos. But what I want to say now is the market engineers exit and entries for the rich traders, right? For the big institutions, for the funds, for people who have a lot of money. Why they do that? Because if you are trading 50 millions in every time, let's say every time you buy a coin, because we're going to talk about crypto, right? Every time you buy a coin, you only buy 50 million. Imagine. Let's talk about, for example, Injective, right? The daily trading volume is 50 million. So if you come and buy 50 million worth of coin, just your single buy is going to be more than the volume of everything that has been exchanged in the day. So what is going to happen? If you buy for too big amounts, you're going to end up raising the price a lot because there's not enough offer at, let's say it's trading at $20. There's no offer. There's nobody offering it at 50 million. So what you're gonna have to, if you want to buy it, if there is someone who wants to buy it and who has a buy order in the book, well, people who's gonna raise the price is gonna rise and rise and rise and rise because people see that there's someone buying at any price. So if you market buy, it means that you're buying at any price, and then you're gonna end up buying your last coin at maybe $80 instead of $20 because it is such a small market and there's not enough offer for you to buy at $20. You want to buy at $20, but if there are only people, like say there are like 2,000 people selling 1,000 worth of coin, so you can only buy for 2 million at $20, and then the rest is going to rise. The price is going to rise. You're going to have to buy the next offer, which is the 22, 24, 25, and then it goes up and up and up and up. Okay, so I hope this is clear. So if you are a big trader with 50 million in your pocket, you just cannot market buy like this, or even put limit orders like this, and people will realize that there is someone who wants to buy, so we're not gonna get our price down. It's like you want to sell your house and you see that there are people running around and wanting to buy every house in the neighborhood and willing to pay any kind of crazy money because they just want it. So you're not gonna get your prices down, right? You're gonna keep raising your prices. So the same happens in the market. Offer and demand. If there is a lot of offer, well, price goes down. If there's low demand, so price goes down. So if you sell for too much, then the price will go down. If you buy for too much, the price will go up, and you will end up paying more than you should. So the market solves this for the people who know. The market will try to engineer a way for people to sell when the price is cheap and to buy when the price is expensive. Why? It's because the smart traders, when the price is expensive, they need to sell. When the price is cheap, they want to buy. But they need a lot of people to sell into them because they want to buy for big amounts. Okay, so how do we do that? Because nobody wants to sell cheap and nobody wants to buy when it's expensive. But still, they do it. Why? People sell cheap when they are scared or when they are forced to. People buy expensive when they are greedy or when they are forced to do so. Okay, so let's take an example. Let's take a quick example because I've been talking a lot, and let's go to the Bitcoin chart. Okay, we'll take this example, and let's talk about manipulation. How does the market and the medias and the news manage to create what is called FOMO into you, fear of missing out? Well, the market, just take the last example. The market will engineer a massive move, right? And in a short span of time, in a few weeks, we have big move. Bitcoin makes a lot of ground, takes a lot of ground, and the news start talking about Bitcoin. Oh, Bitcoin has risen over 100,000. So you could just know, once you know all this, that what the market wants to do, you know that the price will go above 100,000. Why? Because the market loves to move past flashy numbers, round numbers. Round numbers is some psychological numbers. So when it goes over 100,000, instead of people thinking it's expensive, it's time to sell, like any strong trader would do, people will think it's time to buy because the news are talking about Bitcoin. I can't hold it anymore. I need to buy, right? When the price goes down below 50,000, like you can see here, that was back in August 24, people get scared and they sell. Well, the price is going to crash, it's down, it's below 50,000. So you can see it happens all the time. Round numbers are used to create fear or FOMO. You see here, right? 49,300 the price reached and rallied. Okay, so the same idea when it goes down. Sorry, it's the same idea when it goes down. The price, I'm just taking like November 2021, price went down, powerful move and go down below 35,000, get people scared, rallies, right? And here we'll take this strong move down, price goes down to 30,000. That was back in May 2021, 30,000. And every time the price went down below 30,000, people will know, put it up. You see? And while people are getting scared, that's when they start selling in numbers. And when people are scared, that's when the big pockets, the deep pockets, and the smart traders, that's when they need to buy because that's their chance to get in. It doesn't matter. They don't care if the price is going back to, like when they buy here, they don't care if the price is going back to 30,000. They don't know because they're not going to ride it to 100,000 anyway. They just want to make some profit. So they have to buy when people are scared. They just have to. Otherwise, they cannot get in. You know, so if you want to buy 50, remember you're buying 50 million every time you trade. So you have to buy when people are willing to sell. That's just what you have to do. The other way you can buy or sell is when people are forced to. So that, I don't want to get into a lot of details, but if you have read a little bit of what I published in the group, you should know by now that when people trade in the futures market, they either take a long position or a short position. A long position when you expect the price to go up, and a short position you expect the price to go down. And people tend to put stop losses because that's what everybody's told to do, and that's also a reasonable thing to do. You have to put stop loss to limit your losses. The problem comes when people tend to put their stop losses in the same spot. It's just because that's what they were taught to do. Every single trading book, every single internet guru, or let's just Google. Let's just Google right now. What is a strong support? Like, No, okay, I'll put it back here. What is a strong support in trading, right? Right, let's see the AI in Google. So a strong support level in trading, a price point where demand is enough. That's bullshit. And then, well, look for round numbers. You see, round numbers are common in forex markets and can create strong barriers to price movement. So even the AI is lying to you. It's just trying to fool you. You see, I already showed you what price does around round numbers. It goes through it. It goes through it just to get people scared. So because everybody scares that thinks that round numbers are strong support or strong resistance, so they instantly feel fear because that's what they were taught in every books and in every publication and by every AI. And also, it's also saying, let me see, strong support. Let me see here. I'm surprised it's not even talking about. Oh, that's it. Yeah, support levels are often found in areas where the price has touched multiple times. I was looking for that because that's such a lie that you see everywhere. So everybody thinks that when triple top, a double bottom, when the price has bounced twice from a level, people tend to think that's it. It's a good support. Oh, that's it. It's a good resistance. The price is not going to go past that. It's so strong. And it's completely the contrary. And whenever you would see price touch twice the same level and don't go through it, you have to expect the price to come back and take it down. The price will always do that because market is engineering these fake levels, so people put their stop losses there, and smart traders, people who know, get ready to buy when the price goes below these levels or above those levels, because you're going to get stopped, and hence you're going to get forced either to sell or to buy.